Nikotaka kujua ndio nikuvalisha mic. Nitakuwa na kutoa.
What is what that? Just circulate the QR code. I think they'll have to scan straight from your phone. Awesome. So you'll have to just pass it around. Hi guys. Thank you for coming. I'm being told that this is the most attended workshop, meaning guys are very keen about regulation. Awesome. So I have told them. Yeah, thank you very much for coming once again. My name is Kakai Alan from the Virtual Assets Chamber that is running this session. And as you can see, we are focused on 4 pillars of regulation. Regulation is like a cube with 4 sides. So there's licensing, there's ML, there's tax, and there's consumer protection. So by a show of hands, how many are interested in tax in the room? Awesome. ML? Licensing? Awesome. Consumer protection? Awesome. So you're in the right room. So this is going to be a very interactive session. There's a QR code that is passing around. You just kindly scan it. And the idea of this session is not me making a presentation to tell you what a lot of you already know. For those of you who have been engaging with me and Felix there and a bunch of other guys from the industry, you understand that we've been making presentations around this issue over and over. But the reason why I call this a hackathon is that we've developed a Google form which has a spectrum of questions. And from the most extreme end of regulation, where government wants to overregulate everything, to the most extreme end of DeFi and Bitcoin Marxism, where everybody is saying no regulation. We just want to moot out in this space and understand, in these 2 extreme ends of this spectrum, where do we stand? Do we want a Wild West with extremely no regulation, no tax, no consumer protection? Or do you want an extreme end where we have an over-regulation from a very hostile government regime? So there's the QR code. As you would project it. Have you? It's okay. Yes. So the QR code will just run through the room for you guys to scan, and then we can start the session. The projector is not. Yeah, we start with the tax. Yeah, so you can communicate the tax. In the meantime, Fred can give you a background of the tax.
So I think we'll start with the tax pillar, and we'll go through the questions once we're able to scan the QR code. So what I'll do, I'll just give you a brief background that will help you, or rather put the questions into perspective. And I know we have players from across the region, but I'll go by Kenya's example in terms of the provisions around digital assets tax. So the taxation of digital assets in Kenya was implemented last year, and it became effective from 1st of September, and it's what is called digital assets tax. So the option that Kenya has gone for is the withholding tax way. So what that means is the obligation to account for tax on digital assets is on the obligation is on the owners of the platforms or the exchanges. So that means, first of all, they're looking to tax the centralized exchanges in any transactions that take place there. And the basis of the taxation is the gross market value of the transfer. And the tax is applicable at 3%. So what that means, you do a transfer on an exchange, the owner of that exchange is required to withhold 3% of the gross market share. That was effective from 1st of September. So that the taxation, the tax base, I'll just give an example of the regime in the other countries. I think other than Kenya, in Africa, there are other big crypto players, South Africa, Nigeria, India, Botswana to some extent, but I'll give the example of South Africa and Nigeria. So in South Africa, what happens, there is no special regime for taxation of digital assets. But for regulatory purposes, it's classified as a financial item. But then if you trade on crypto or virtual assets in South Africa, they deal with it under the existing regime for taxation. So that if you're holding these assets as an investment, like shares, and then you sell them, it will be taxed under the capital gains tax regime in South Africa. Or if you're trading in them in the normal sense, then it will be taxed under the usual corporation tax regime. So that is South Africa. They went for that, no special regime. For Nigeria, they created a special simplified regime. They look at the net gains that you've made, and then they tax it at 10% on the person doing the transaction again. So key to note is Kenya, it's withholding tax obligation not on the trader, the person realizing the gain. It's on the owner of the exchange. And that means that KRA will enforce from the level of the exchanges and not the trader, the person realizing the gain. So where are we now in terms of proposals? So on the bill that BAK together with other stakeholders proposed, we proposed a very simplified version, and this is from feedback that we got from the MPs, because we were struggling with how to characterize these gains. Is it capital gain? Is it trading? So what we went for is a simplified version where we are saying if you bought assets and sold it within a year, 12 months, then it will be taxed normally as income tax. That means if you are a company, you will include it in your under your revenue as a business, take deductions on all the expenses that you've incurred, and then subject it to tax at 30%. If you are an individual, you will include the gain as part of your other income, and it will be taxed at the highest band. So if your highest income is taxable at 35%, 32.5%, then that means the gain from that transfer will also be taxed at that higher rate. Yeah, so that's one. And then number two, if then you hold these assets for more than 1 year, the simplified route that we took is when you sell it, then it will be deemed to be a capital gains tax. You can get deductions for all the costs that you incurred and then tax the net gain at 15%. So that's the proposal that is currently contained in the bill. So I think with that background, you can attempt the tax questions, and then we proceed from there.
Yes, we'll take them through it.
Okay.
Okay, I'll take them through.
Okay.
Now, I believe everybody has scanned the hackathon questions. So the idea behind this question is for us to figure out if ever, we're doing sort of a poll, but at the same time we are figuring out if ever we're going to do a report to government. How will that look like from these extreme ends of the spectrum? So for the sake of time, we'll go straight to the tax questions, which Fred has already given you a background on. You've scanned? Yes, scan so that you can talk. So the first idea is, number one, as Fred has said, there's this digital asset tax. In principle, it was the tax that was imposed on traders, not exchanges. The role of exchanges in that tax regime was to collect. It was a 3% transactional tax based on how it was structured, so that if I'm selling Bitcoin on for instance, Binance is supposed to withhold that 3% and remit it to the revenue authority. Now, that leads me to my the first question in the hackathon. Now, imagine you are either a boss at KRA, or you are the head of this digital asset tax at KRA, or you're a person who has sort of some influence to decide how this would look like. What best case approach will you take? I've provided 6 approaches. Number one, you can either implement a very strict high tax on all digital transactions to ensure maximum revenue for the government. So the guy who is on this extreme end is just focused on the maximum revenue for the government. Number two, either introduce comprehensive reporting with high penalties for non-compliance. So all these exchanges will still be required to report to you, but there's high penalties for guys who do not comply. Number three, either apply a moderate tax rate with incentives for businesses that comply. So for instance, as Fred has said, the digital asset tax came into effect on September. A lot of businesses have not complied. So how will that look like if they not comply? Then the fifth one is implement very low tax reporting requirements. And the last one is do not implement any tax requirements at all and let the market self-regulate. So these are guys who are on the extreme end, and they want they are pro DeFi Marxism and want self-regulation. So what I will need of you is just to pick one of the selections. Are we together up there? Then the second question now, imagine we are figuring out tax rates. Now, Fred, you can cover that, of the tax rates.
All right. Yeah, so then once you respond to the first question, then you look at the second question is about the rate. So which rate will apply? Will we do 30% on profits? By this I believe it's net profits.
Net profits.
Net profits. So that's like the usual corporation income tax regime in Kenya. Or will we do 15% on the profits again? That would be in line with the capital gains tax in Kenya now, where it's gain 15% on the net gains. Will we do 3% on all transactions? That is the current regime for DAT in Kenya, where the exchange owners are required to withhold 3% of the gross market value of the transaction. Or will we do 1.5% on the transactions, again, the same concept, but just the reduced rate at 1.5, which would be equivalent to digital services tax regime in Kenya. And then the last one is no digital tax, rely on self-reporting and voluntary compliance by traders. So you say you don't tax, just let traders feel free to, comply and self-report. So that if it's an individual, then they just declare it in the income tax return and pay the additional tax without providing for any specific rate. Then the next question is about the tax reporting method that would be implemented. So the first one is government mandates exchanges to collect and report all transactions data. I think we sort of incorporated that in the bill in terms of exchanges being required to collect certain, the originating exchanges to collect certain information, because one of the key concerns of government is how will they have sight of these transactions. So that speaks to that, where you mandate the exchanges to collect the transactional details of the traders.
So mandating M-Pesa and banks to provide.
Yeah. And what is being proposed now, where KRA can just obtain M-Pesa transactions and use that for purposes of assessing tax. Then the other one is still the exchanges reporting to the government with strict oversight. So we have government involved. Let's say if it's the CBK, CMA, or whatever body is oversighting virtual assets transactions, then they oversight that exchange of information. Then exchange reporting transactions data with some government oversight, not too much oversight, but just slight to ensure that, given the interest of government in terms of AML, counterterrorism financing, and stuff like that. Then option D is traders self-reporting transactions with guidelines and support. This would speak to the current regime, but remember, if KRA can't catch you, what incentive would you have to self-report? Unless you're sure they'll catch you. So bear that in mind as you respond. Traders self-report transactions with minimal government oversight. And then the last one is traders are fully trusted to self-report with no mandatory oversight. You self-report, you don't pay, there are no consequences, no penalties, no interest. And then we move to the next question. Propose a groundbreaking way to make digital asset taxes work the same way in different countries. How would you deal with the different laws in each place? Develop a universal strict international tax rate for all digital assets. So this speaks to collaboration, whereby we have standards that apply across, and I would equate this to, for those of you who are familiar with transfer pricing, I would equate this to transfer pricing, where we have globally agreed standards at the OECD level, and now what you do is you just adopt them at the country levels and tweak them to fit your laws. So I think that's what option A speaks to: develop a universal strict international tax rate for all digital assets. So we speak to taxation at a universally agreed level, create a detailed international tax treaty with stringent enforcement mechanisms. That still speaks to the first one, but as we know, the treaties could be bilateral, one country and another, or multilateral that encompasses many countries. Then encourage countries to adopt a common set of tax guidelines with some flexibility. And while you think of just think of the cross-border nature of digital or virtual assets. You could have a country, an operator in one country, but you have users across different countries. So then the uniformity would help in that sense. Then option D, propose a general framework that countries can adopt based on their needs. So general framework, not binding, but countries can tap into it as they come up with their own regulations. Then E, suggest voluntary guidelines for countries to follow if they choose. That's closely related to D. Then lastly, allow each country to set its own tax rules without any international coordination. I think that's what is happening currently now, going by the example that I gave of Kenya, South Africa and Nigeria being the leading jurisdictions on crypto, and you can see how diverse their tax treatment is. So each country is just free to do their own thing, and the challenges that come with that, again, is the cross-border nature of virtual assets operations. And then the next question is, come up with a bold plan to include digital assets in the current tax law. How would you address concerns from both traditional banks and the crypto community? So I already spoke to what is suggested in the current bill. So first option A, implement strict regulations and high taxes for digital assets to match traditional assets. So that would mean, if you're looking at securities, shares taxed at the CGT level, should that apply to crypto so that you treat them as you would treat shares? Introduce detailed compliance requirements with significant penalties for non-compliance. That is on the regulations and enforcement. So should the applicable penalties and interest apply to crypto assets, or should there be a special regime just to encourage growth? Propose moderate changes that include both taxes and some incentives. So this would be you're enforcing and regulating, but you start at a lower level, at a more lenient level than what is currently in the market, just to allow players again to come in, and then you can tighten the regulations later. Suggest minimal adjustments to existing laws to accommodate digital assets. I think that's what is happening now under the DAT. It's taxable under the withholding tax regime, which is already existing. Then E, offer substantial tax breaks and simplified reporting for digital assets. The tax breaks would be basically incentives, whether you're offering them to exchanges or traders themselves. The aim would just be to, allow for compliance, rope in more people, and then you can always escalate later. Then F, keep digital assets tax free to encourage innovation and growth. Going by what KRA has been saying, that's very unlikely because they see value and they want to tax it. There are these huge figures that they keep quoting, and they want to tax that. Yeah, is this still tax about the scams?
That is consumer protection.
The scams, yeah. No, okay. I think the next one is on consumer protection, but you can fill it, and the next person will come and pick up. How would you protect people from crypto scams? And again, when we appeared before the MPs, this was a very key concern of theirs. They kept drumming up the issue of consumer protection. And of course, they're banking on the scams and the reports of people having lost money and such. So it was key for them, for us as the stakeholders, to demonstrate how we will put in place measures that will protect consumers so that people don't lose money. And as you can imagine, that goes with credibility. If you can demonstrate to someone that they're protected, these things are regulated, that would give it credibility and create value. So how would you protect people from crypto scams? Require mandatory registration with government agencies for all crypto companies. By this, is it the trading companies? Is it the exchange owners who then should register? Mandate comprehensive background checks and licensing. This speaks to KYC. For instance, if someone wants to do an initial offer Would you require them to provide enough KYC information? C, develop a balanced approach with some government oversight and industry standards. This kind of a mix where you rope in the government and then allow the industry also to contribute towards that. Then D, encourage voluntary self-regulation with some government guidelines. So there's a mixture of self-regulation and slight oversight from the government. Then E, suggest minimal government involvement and rely on industry self-regulation. And then lastly, let the market fully self-regulate without government intervention and trust consumers to do their own. So you'll note that the questions are, we start from one extreme and end at the very extreme, with the first extreme being a lot of government oversight and regulation and high taxes, and the lower extreme being self-regulation and no taxes or a lot of incentives. So with that, I'll hand it over to the next facilitator.
Yeah, the idea was to have us complete this assessment so that we go to the next discussion point. But we sort of running out of time. How many? So the tax session is already complete. Should we just go straight to questions for the remaining 5 minutes?
For tax questions.
We can have tax questions.
Yeah. Or any other questions.
Or any other questions.
Yeah.
Okay.
KRA and Parliament, I feel like they're trying to see tax in two ways. One, they want to tax gains, but they don't know how to do it because they can't access personal traders. So they're using the platforms to tax those gains from the traders. So if they can find a way of accessing the traders, they are happy taxing gains rather than the current way the mode of the law is. That's one. Then two, they also seem to want to have what you'd call a transactional tax, a form of, like if you see when you're doing bank transactions or mobile money, you see the very small figure on each transaction that you make. The questions, we've covered the tax on profits for both individuals and corporates. We've also covered gains, if at all it's an asset and then you tax the gains in a period of 12 months or even more if there's a buy or sell. But we've not covered that transactional tax, which they seem to be very interested in, because for them, they want to they feel it's hard to access the traders, which rightly so it is, and the easiest way is to use entities that they can find, hence the platforms, the exchanges, and so they want to implement this transactional tax. Maybe a very, very small figure, maybe 2 Kenya shillings, 1 Kenya shilling, something so small that each trader wouldn't feel it on any transaction, and it would also have a cap. For example, even if you're transacting more than $1 million, it won't go, let's say, above 100 Kenya shillings, something like that. So I haven't seen that proposal in the tax questions, which would also be another way that they might be interested in, so that it takes it away from a digital assets tax and now it goes to an excise duty or stamp duty form of tax.
How much is the excise duty or the transfer tax for bank transfers, for instance?
How much is it? For each transaction you do?
15%.
No, that's too high. It's a very small figure, like 0.001.
It's 15, they want to introduce it to 20, it's 15.
Which one? No, excise duty.
The clarity is what excise duty is levied on bank transactions is the fee that they charge you, not the transaction value. It's the fee, so that if you're transferring 1,000 shillings and they're charging you 50 shillings for that, they'll do excess duty at 15% on the 50 shillings, which is now proposed to be 20.
Yes.
Yeah.
So by this approach, it means an exchange or from service provider would incur a 20% or 15% excise duty on the fees that they
charge, and ordinarily that fee is passed to the consumer. so that you pay the fee plus the duty on it. And then for stamp duty, it would be stamp duty applies on the instruments, on instruments that are used for transactions. So that if for instance sale of land is subject to stamp duty, you'd be charged stamp duty on the sale agreement. And of course, it's either nominal value or a percentage of the transaction value. I think in this case it would be nominal, so that we have a fixed value. And that also assumes that the transfer itself will be made pursuant to an instrument, so that there will be an agreement that then is stamped or is required to be stamped, in this case at a nominal value, say 100 shillings or 200 Kenya shillings. So yeah, I agree with you, Idlin, and I think we mentioned it while we were with the MPs, because they kept saying they want something. And to me, I think the excise duty or the stamp duty would not, the main purpose would not be revenue per se, because like for the stamp duty it would be nominal, but I think it will be part of enabling the government to have sight of who's transacting and who are the parties, who's buying, who's selling, and then now they can chase them for the bigger thing, which would be the tax on the profit or the net gains that arises from that.
Sorry to interrupt.
Yeah.
It's similar to what you're referring to. So for the VAT,
Yeah.
the proposal by the Finance Bill 2024 to increase to add a 16% VAT on transactions. And so I wanted to know whether that's something that is going to affect this space, and whether that's something that you've talked to the bank about. Because from my knowledge, I know it's going to be affecting transactions like clearing of checks and things along that line. And so it would be important to find out whether this is something that's going to affect us as well.
Yeah, so I think before the proposals, the general rule has been financial services are exempt from VAT in Kenya. Yes. And the aim of that, or the justification, was just to help bring people into the formal financial system by taking away the VAT, because VAT would ordinarily be again a cost to the consumers. So they were exempted just to allow more people to be brought into the formal banking system. But as you rightly pointed out, there's a proposal to subject some of those transactions to VAT. Sale of debt for consideration and forex transactions and such like transactions. So it is possible, depending on how the virtual assets transactions will be categorized. It could fall under, it could be subject to VAT. It depends on the characterization. But again, I think as a starting point, and just to allow the sector to grow, it can be proposed to the government to exempt it specifically, so that virtual asset transactions are not subject to VAT, and to allow it to grow fast before you tax it. But as it is now that the government has started taxing the financial services sector, nothing would stop them from proposing VAT on there.
Sorry, one last comment. I think it's also important to put into consideration some of the effects of taxation that have been imposed on companies. So if you're looking at an international company, the raft of taxes that they need to pay would make it very prohibitive to get into the Kenyan market. Because if you're looking at, for example, the VAT, if it's introduced, if you're looking at DST, like, it's a whole raft of taxes. And so as opposed to discussing all these things in isolation, is there a possibility of them defining it as one singular thing? Because for a person who's wanting to get into the Kenyan market, it doesn't make sense.
And I think for the benefit of even people who they're pulled from the region and also come from beyond Kenya, it would be important to just list the taxes that an international company operating in Kenya as a virtual asset service provider might incur.
Yeah.
Taxes that a local company operating as a virtual asset service provider will incur. Taxes that we expect individual traders, asset holders to incur. I think that will set a basis to
Yeah. So I think for international and local, they would pretty much be the same. Maybe save for something like VAT, because so if you're operating here as a company, of course, there's the 30% on your net profits, on net gains, and so there's that 30%. There is VAT on any vertible services that you consume, vertible services and goods that you consume as a company, or rather in the course of your business. So that's a further 16% plus 30%. And there'll be excise duty on services and some of the goods that you consume as well, ranging from between 5 to 15, and from 1st July maybe 20%. So it will depend on the nature of the services that you are offering. And then if you are importing anything, any goods, of course there'll be the import VAT at 16%. There'll be the customs duty ranging between 10 and 30%. And there'll be some of those items, if they're excisable, again, excise duty ranging from, again, 5 to around 20%. And so those are direct taxes that you would incur as a company. And then now there are obligations for other agency taxes that you're supposed to do. That is the withholding tax. If you're paying for any qualifying services, you'll be required to withhold tax at between 5% if you're making payment to a local person, to 20% if you're making payment to an unresident person. And there'll be, of course, PAYE on any employees that you have, including those statutory deductions again. And I'm calling these duties because if you fail to withhold, even though it's not your tax, the KRA will come after you for the principal tax, penalties, and interest. So it's still a possible area of concern. And then, as I said, the main distinction for me between non-resident and resident would mostly be, so of course the non-resident will not be doing importation into Kenya, so those import taxes will fall off. And then VAT for any services that they supply to Kenya would be, they'll be exporting from their country into Kenya, so it should be zero rated in their country. And then whoever is importing in Kenya should account for VAT if it's goods, import VAT, if it's services, reverse VAT. And then for individuals, I think the main, especially if it's not in relation to you're not employed, the main obligation will just be PAYE. You're a Kenyan resident, you're supposed to declare tax on your worldwide income. So if you have employment income, you do your normal employment income, then you put other income and lump it up together, and then it will be taxed at the highest tax rate, depending on your employment income. But even if you don't have employment income, the obligation, the expectation from the government is that you self-declare and pay tax on that income that you've earned as a Kenyan resident person. So I think that would be my general overview of the tax obligations. Yes.
My question is,
will you go to the other pillars?
This discussion with the members of parliament.
Yeah.
Did any of sort of arbitrage scenarios arise in terms of, for example, if I'm dealing with virtual assets, and in terms of registration, or in terms of the services or goods that I'm dealing with, they are not physical in nature. So that means, what that means is that I'll look around and see where the legal framework is a bit conducive. For example, like Dubai would come to mind, and I would critically think hard in terms of between registering in Kenya and Dubai, which one is more advantageous to me? Yeah, in terms of, so I don't know, did such kind of discussions arise, or that was overlooked, or how was it? How are they taken care of? Because I'm sure you said that you looked at the other regulatory frameworks in other regions and sort of you benchmarked. So what kind of discussions did you have and that made you guys arrive at that?
So where we are coming from, when we had that discussion, we're coming from a background where we already have digital assets tax applying in Kenya, and there's this obligation already accruing to people who are operating here. So it was a give and take, and the MPs made it very clear there is value here that we need to tax. So it was a discussion of how best do we tax this value and still take care of the player's interest. And just to take you back, you see for corporations that are exchange owners who are operating here in Kenya, you're already required to pay tax under the normal income tax framework. So you can't run away from that as long as you're carrying on business here. And then, of course, I take your point in terms of someone can shift to Dubai, and since their business is online based, they can still access Kenyan users from there. And in that case, they'll fall under the digital services tax regime and pay tax only on transactions that have been done from Kenya. So while we may have mentioned that to the MPs, that wasn't their concern as much. They were mostly concerned with the value that they perceive that is being created here and that they wanted to tax. And just to give you an example of how difficult it can be, I mean, the chairperson of the finance committee the other day was telling manufacturers to go set up in Uganda and export to Kenya if they are worried about the eco levy that is coming up. So that's the kind of the government we are dealing with. So they don't seem to appreciate the value of even investing here. They don't appreciate that they'll get more tax when someone is operating from here because you'll have the employment taxes, the VATs and everything. So yeah.
Based on the wording of the DAT,
Yeah.
as long as the users were in Kenya, were you supposed to remit and withhold tax for them, whether you're operating locally or globally?
DAT? Yes, owners of exchanges, yeah. As long as you have an exchange here.
Or
And
if it's in Dubai, and your users are in Kenya?
you're supposed to.
Okay, you can
Yeah.
cover that as well.
Okay. So just to explain that again, so for both digital services tax and DAT, based on the wording of the law, so if an exchange owner has any user in Kenya carrying on those transactions, then they'll be required to account for tax. For DAT purposes, withhold tax on that transaction and remit it to the government, regardless whether you're based here or not. So you don't have to be based here. But now the challenge is if you're not based here, then how will the government enforce? It is easier for the government to enforce while you are here. But even for digital services tax as it is now, we've seen non-residents registering here just to comply with the digital services tax, the one that applies at 1.5% of the gross value. Yeah.
Me personally, my name is William Hassan. So I have a question based on I have a question based on how the digital asset tax laws are being derived. You see, basically, personally, I believe that by guaranteeing more trust in natural language laws, blockchain smart contracts will become the laws of the future. So if you derive the laws from the digital asset, if you derive the laws from the natural language laws, I think there's a lot to learn on the blockchain ecosystems. So for it to work, you must derive your laws from the smart contracts themselves. Because even collection and remission of taxes to the tax commissioner, this can be automated by a smart contract. But if you depend on the services, financial services themselves to collect and remit, there'll be a lot of discrepancies. So can I get your take or your perception on how are you guys planning, or how are you deriving the digital asset tax laws? Thank you.
Let me try and take that. So as long as, for instance, guidelines are clear, let's say an exchange has been mandated by the Revenue Authority to withhold 3%. I think what they'll just do, they just pass a code to their existing smart contracts. So for instance, usually transaction Binance, they already have some transaction fees that they deduct for your swaps or for your exchanges. So in addition to that transaction fees, you'll have a smart contract also. Now you'll have a new line of code on the smart contract also now hitting you with a digital asset tax. Now the question of whether or not it will be a full circle contract whereby the moment it hits you, it settles KRA, that will not happen because KRA are not very keen on setting up a crypto wallet. Because for that smart contract to work, it means Binance automatically deducts 3% on your transaction, and that 3%, the smart contract already settles it on a KRA MPC or wallet. KRA don't have an MPC or wallet, and that is where it brings the implementation headache, whereby when the exchange withholds, they have to off-ramp to a bank account outside the country because they don't have a Kenyan bank account, and physically send it to KRA in form of Kenya shillings. But if KRA was open to having smart contracts integrate with basically integrating with the full ecosystem of virtual assets, whereby I transact, transaction fee goes to Binance, 3% is withheld by the smart contracts, it lands on a KRA MPC, the exchange doesn't need to off-ramp, KRA receives the USDC, USDT, and they find a way of off-ramping themselves. That is the only way the smart contracts will work, unless you have understanding.
Yeah, that's true. And just to contrast that, the way it is now and the way KRA is envisioning implementation is very different. They're looking at it based on the current operations.
Yeah.
So to them, they think the exchange owners have access to these assets, and they can actually withhold, say this is 3%, take 97%, let me give this to KRA. So they don't understand the nuances of how it works. But I hope they'll get there, because that's what South African Revenue Authority is doing. They're actually investing in a lot of tech to feed into the various exchanges and everything, so that they can be able to have sight of this and have the monies and assets being transmitted to them real time, as and when the transactions occur, without the need to, off-ramp and then do the translation and pay KRA in fiat and stuff like that.
Another question. Was VAT a final tax? For instance, I'm in the business of, just let me air out my question. So for instance, if I'm in the business of trading, right?
Yeah.
I'm a full-time trader, and an exchange withholds my 3%.
Whether you can
tax.
claim the credit.
At the end of the year, when I'm doing my corporate income tax as a company, can I claim the credit for all VATs that have been withheld?
No, not to the extent that it's not expressly stated, because what the Income Tax Act does is if withholding tax is meant to be final, it expressly states that this will be final tax. It was not stated, and that's one of the issues that we raised, if you remember, in the petition, that it's not clear. Like for a company trading in crypto, there'll be tax normally under the corporation tax, and then you still withhold 3%, but then they don't claim the credit for the 3%. So as it is, it's not final tax, because it's not provided for expressly. Yes.
I want to understand when you're getting it right. This is a buy and sell tax. It's not yet like established whether you're going to have like perpetual trading taxes or holder taxes, like crypto holders, or even any other trades. It's just a buy and sell on a centralized wallet. On a centralized exchange. Not when it comes to DEXs, right?
So as it is now, and the law expressly refers to owners of exchanges or people who facilitate the exchange. So that would imply that it would be centralized exchanges. And then I don't know what you mean by buy and sell tax, but it is. So there are two things. The tax burden will be borne by the trader, the person who's done the transaction. So you do.
Okay, let me explain. Like the transaction of fiat into crypto, not like any other trades like perpetual trades.
Oh,
No,
okay.
so from how the
Yeah,
tax was worded,
I get.
it was not an on-ramp, off-ramp tax. It was a transactional tax.
Any
which means
transaction.
If I'm swapping USDC to BTC,
Yeah.
the exchange will still have to withhold 3% of whatever that is, whether it's in It was a tax on the transfer of virtual assets. Now the problem is when you talk to them, they're saying it's a transfer when you're buying and selling, when you talk to them. But when you read the text in black and white, the text, you know when it gets to court or interpretation, the court will follow what?
And those are some of the issues that we've highlighted, because now you're saying transfer. There are so many transfers happening, but then how do you tax it? What do you withhold? And then how do you remit what you've withheld? Yeah.
Yes.
Yeah. But KRA, their basic understanding is the off-ramp, because they keep referring to conversion to Kenya shillings and stuff like that.
All right, give them a round of applause, guys. I'm coming here 2 times. She can attest, and I showed them the banner. So I know you're hungry. I need to release you because you have an exciting afternoon lined up, and they will still be able to recuperate what we've discussed. So please, just go to the lunch area, enjoy yourselves, feed yourselves correctly, and I will see you back at the conference section in 5 minutes. Give them one last of applause.